Hi, this is James Eng with Old Capital, and this month's webinar for February 2025, I am titling Choppy. And so let's just jump right into it. All right. So on the Class A side in today's market, I would say it feels like this. The Class A properties are riding on top of the wave. It is definitely choppy in today's market. The Class A properties are definitely waving or riding on the top. And appreciate the AI generated images here. Uh, and then the Class C properties right now, unfortunately, it feels like they're underneath the wave. And what is the wave? The wave is new supply. The wave is higher interest rates. The wave is higher insurance, right? So both classes are facing this, but right now the amount of liquidity in the Class A space is preventing those properties to really feel it. And so here's an example. So this is a Class A property, right? Probably 10 minutes from my house at Tollway, George Bush, and the lender took it back. Someone bought it at the top of the market. Ironically, that group is named Tides, and the lender had the foreclose on the asset, January 7th, and they had 12 offers in 3 days after they got foreclosed. And one group was willing to go non-refundable with $1 million, and they signed the PSA on January 27th, and it just closed. And so, like when you look at this transaction, this is sort of what is happening in today's market. These deals are getting like people think there's distress, which there is a little bit of distress, but on the Class A side, these deals are getting picked up really quickly, right? So if you look at this deal, it was originally done in 2021, and then it probably got extended a couple of times, but then eventually just ran out of time. And the new group that came in not only got a loan from the existing lender who foreclosed on the property, but then they're a local group who, they have close to 35,000 units right now. And so what we're seeing is guys who are necessarily from local guys in Dallas are picking up these deals of size right now. And so on the A side, it's like if there is a foreclosure, it's getting picked up very quickly. On the B and C side, it's taking a little bit more time, right? So you're seeing listings, deals that are back on the market because they couldn't raise the equity, or deals that are pretty much at the loan balance, right? And so when you go back and look at this deal, this was 66 million over 376 units. So it's like one, um, I don't know if it traded right at that price, but the new loan was close to 56.5 million, right? And so if you just do 80% of that, 75% of that, you're probably pretty close to the overall purchase price. And so we're seeing these deals trade at pretty much the bridge loan balance, especially on the BNC side. All right. So, that was just a little taste of what we're going to go through today. But we're going to go through sort of what happened in Q4 in DFW in terms of sales, and then even what's happened so far this year in DFW. Talk about a couple foreclosures, and then we'll really get into the overall sort of macro multifamily piece in terms of supply, demand, operations, what people are doing for acquisitions. And so we're going to look at broker reports and earnings calls and sort of mix those two back and forth. And then we'll talk about financing, how these deals are getting financed. And then, so if you want a copy of the slides, this deck, just hit the subscribe button, like this video, all that type of stuff. And then email me just at my email here at the bottom. All right. So, my background, born and raised in Houston, went to school in Austin at UT. And then I worked for G Capital for about 10 years on their commercial real estate balance sheet CMBS program as an underwriter. And then really the last 10 years have been focused in on multifamily throughout Texas, originating over 1.5 billion in loans over the last 10 years, and then invested in a number of properties throughout Texas as well. Oh yeah, our big event. So our big event, we just announced this last week. Old Capital Conference will be October 8th and 9th. This will be our ninth annual conference. So if you have not been to one of these, we usually have 400, 500 people from across the nation who are interested in multifamily. So go to oldcapitalconference.com and you can register for that event. All right. So in terms of the fourth quarter, it definitely picked up. And, a lot of these transactions, when 10-year treasury dipped below four, a lot of these transactions, they either got under contract or, a lot of refinances were done. But this was just in terms of sales. I would say a lot of these sales were, larger acquisitions. They mentioned Blackstone's here. A lot of these, like, not only $10 billion acquisitions, but a lot of $1 and $2 billion portfolios were bought in 2024. And so the transaction volume was up. But I bet if you looked at this, it was pretty chunky in terms of 2023 or 2024 versus 2023 versus the smaller deals. But if you go back and look, I mean, this is sort of your volume, sort of 2014 to 2015. And, that's on definitely higher pricing. And so, definitely a smaller number of transactions than done in 2014 and 2015. And still way off the peak, sort of a 21 and 22. So when you dive into, all right, so how did DFW do and sort of what the trades happened? So about 63 properties or 15,000 units traded in Q4. This is per Yardi. And the top end of the range, I would say this is like sort of A plus to A minus. That was like 80-90% of the transactions, right? So if you look at 63, seven of them were sort of workforce, and the rest were sort of your discretionary upper middle range. So this is really your A plus stuff. So 80-90% class A, and then sort of your B minus and C stuff, it was only like 10% of the trades. And then in Dallas, this is per CBRE. In Dallas, they're looking at sort of your class A stuff at 4.5 to 5. Value add, I don't think there's enough transactions. So this number I think is skewed way downward. But the exit caps that people are still using are 5.25 on core and value add. All right, so we've got a good number of trades, 60 trades. So I'm gonna hit the highlights of these. And remember, if you want the slides, just email me and you can see all the deals that traded. So I put sort of how these deals were financed right next to it. So you can see, starting out, most of these were agency loans. This was a deal that was ironically pretty close to that deal that we talked about at the beginning, in the same pocket. And it got foreclosed. And then the lender actually did an HFC. So they went down to Cameron County and got an HFC done on the property. And so, there's still a window on the HFCs. If you have not looked at that or considering look at that, there's still a window to get some of those HFCs done. So they did an HFC. And so Cameron County now owns the land. And the lender is still owning that property. That property is at 66% occupied today. You see some of these larger deals, loan assumptions on both of these properties. And then the smaller deals, I mean, Freddie Mac SBL still seems to be the key financing option for a lot of the smaller deals. I would say under 100 units is where a lot of those are getting done. All right. In terms of the next page, okay, so a lot of these green ones, those are all Fannie Mae. These are loan assumptions on this Class B deal. This is a Fannie Mae loan, Freddie Mac SBL. And then in terms of, a lot of these deals that were done, let's say in 2019, 2020, they have low, fixed rates for another 4 or 5 years. And so those are selling because the exact loan amount, how much term you have, and your rate, and so you can sort of back into how much you're willing to pay. This is another one. So Freddie Mac did this, and this was a traveling HFC from Pleasanton. And this was when sort of Freddie Mac was quoting those deals in the sort of end of Q3, beginning of Q4. And then, most of the look on this page, I mean, majority of these deals are getting done with Fannie Mae, and the fixed rates are right in that sort of 5.5 to 6% range across the board. And a lot of them are doing, 5-7 year. And then this one down here, Hampton Townhomes, it still has to hit 90% occupancy. And, in the heyday, 90% was sort of easy because everyone was 95 to 97% occupied. But now it's harder for sure. And so if you're not able to get your property to 90, 95, the new buyer has to come in and get a non-recourse bridge. So this deal was done on a non-recourse bridge. As you see, the occupancy is 85% down in Crowley. And then, as you get up into some of the larger properties, these are 300 units, Class A properties. The life insurance companies are financing some of those. And then this MAA Cathedral Arts, it was in lease up, 43% occupied. We're going to talk about that one in a little bit more detail as we get into the REIT reports. But as you can see, a lot of these, I mean, everything on this page except one deal was as a Fannie Freddie. And then there's some buyers like Rise who has continued to do non-recourse bridge throughout 21, 22, 23. So even though these properties are 90, 92% occupied, they usually are doing a pretty big upgrade on these properties, and so they're using non-recourse bridge still. And then let's see. So let's get into the first half or sort of first couple months of this year. And we've seen a lot of, so we saw this Alexia at Willow Bend. So this was the very first deal that we talked about. So Benefit Street took it over, and then from Tides or foreclosed on them, and then they sold it to Nightvest, within less than 30 days. And then Bristol's, this was a deal, Class C deal, occupancy struggling at 80%. Veris took that deal over. And then, so this was another example, this Monty deal, where basically the existing owner, which I believe was GVA on this deal, the occupancy was down at 57%. And so now S2, which is a local group, came in, bought the deal, got some pref equity, and put it on top of the deal to make that work. And then we're seeing more non-recourse bridge here in the first couple months of 2025. These deals, some of these larger deals, I understand it. I'm not sure on some of the smaller deals why they went non-recourse bridge. The one benefit I would say is the interest rate caps are a little cheaper, and if rates keep coming down, then you do have that prepayment flexibility. Some of the foreclosures that we saw, the last couple of months have been in San Antonio. So this was a deal, 50% occupied. So, one of my rules of thumb is really sort of get if you're going to be in the deal for a while. Most people are pretty safe doing sort of an agency loan, fixed rate, for 7 to 10 years. And on this deal, that's what they did. But you still have to maintain occupancy. This one dropped to 50% occupancy, so it got foreclosed by Fannie Mae. This one, similar story, 70% occupied in San Antonio, got foreclosed as well. And so when you look at the interest rate environment right now, it doesn't seem like the Fed, anybody's in a rush really to get the federal funds rate down. Trump has said that he's focused on the 10-year Treasury, which is great. That helps Fannie and Freddie, lend more money out. But we saw a 100 basis point cut over the last 4 months of 2024, and so far this year has been flat. And so we're just waiting, really, to get inflation down. But with GDP growth still strong and unemployment still low, they're really in no rush to bring it down. And so now I'm going to sort of combine some of the broker reports that we saw and what the sort of larger REITs, more in the A minus space, are seeing. And so, Camden, they probably have 50, 60,000 units across the nation. And, in their sort of overall market update, they're everybody's optimistic because they're seeing deliveries sort of peak out really last year. And then this premium between to own a house versus rent an apartment is at historic levels. And so, I just want to go straight to the data here. So this is from Newmark, and um, you can see in 2024 these deliveries hit. I mean, I think you have to go back to like the 70s or 80s to see deliveries this high. And so you're hitting like 3% of inventory at this level. So think about it as, let's call it, if you're doing 150,000 a quarter, you're close to 600,000 units being delivered. And then in 2025, you're slipping into three to 400s. And then 2026, you might be, 200,000. And so you're going from 3% of inventory growth to 2% of inventory to 1%. And so a normal market is probably in this sort of 1.5 to 2%. That seems to be sort of 16, 17, 18, 1.5 to 2%. And so it doesn't, what's hard is it's hard for developers to start developing right now into this environment because rents are flat and then interest rates are high and construction costs haven't really come down. So it's hard to make those deals pencil. And so this pipeline, it takes 2 years to really get a deal going and get it constructed. And so it's becoming more difficult for people to start right now. And this gap, I mean, I guess it started really in the back half of 2022 when interest rates started going up, and then single family pricing really has not um, gone down, right? So multifamily values have come down, but then single family, the price of homes has kept going up, and interest rates have gone up, and so this piece of it. $1,100 gap between renting versus owning is huge. And so that's going to prevent a lot of people from moving out. And so a lot of the REITs were saying, typically they might have 20% of their tenants move out to buy a home. Now it's like half of that. Now it's closer to 10% or underneath that. Blackstone, they made a big bet. I mean, they put $10 billion down on a deal last year. And sometimes people are saying they're talking their own book a little bit, but they've been right a lot. Uh, Overall, they've been right for a really long time, and so a lot of people listen to them, and they feel like the recovery is underway. They deployed 25 billion in 2024, was up 70% year over year. And they said, look, the economy is growing. You're going to need more real estate. So rents and value have got to grow. They're leaning in because they think it's not necessarily going to be like straight up and to the right. Might be a little bit choppy, but it's going to be a recovery. And they right now CPI, they're saying 36% of it is shelter. And right now that's 4.6%. And overall they see, rents right now at 1%. So they think that's going to come down. And then also the labor market, they think it's pretty much imbalanced. So you're not going to see this huge wage growth as well. All right. So, the demand for multifamily, as we showed with that sort of rent versus owning, this number was pretty similar to sort of 2021. And so on a quarterly basis, that is a huge number for sort of the back half of 24. And so everybody's hoping that continues in terms of the demand for these units because that is a big number. And, a lot of these REIT guys, in terms of operations, they're still seeing trade outs down, right? So negative lease over lease trade outs on the new side, but the renewal side, they're still growing at 3 to 4%. And a lot of these deals that MAA has, they're trying to keep occupancy closer to 95%. They're still upgrading units. They're getting about $100 and they're leasing them about 10 days quicker. And their expenses are still, growing about 3%. But then, you put that on top of the revenue growth of, that is just above 1%, their overall NOI is going down year over year. Camden seems to be doing a little bit better on the revenue side. Their blended is about 1.3 for the full year 2024. Their NOI was about 1%, and they think the full turn in getting positive new leases is going to be in the third quarter of 2025. So I think a combination of the summer spring leasing season plus having occupancy at 95%, then they don't have to give away as so much in concessions, and there won't be as much new supply giving away so much, and that'll allow them to turn to the positive new leases. And so we're seeing vacancy come down a little bit here across on a national basis. But in terms of rent growth for the Texas markets, we're getting hit pretty hard right now just because of all the new supply. So you see Austin is sort of your worst performer on rent growth. San Antonio is right behind it, and then Dallas is I would say towards the bottom half as well in terms of new supply, and then Houston's right in the middle, sort of at zero. And so you're seeing sort of the coastal markets with not a lot of new supply still being able to get solid rent growth right now. And so are these guys buying anything? Yes. So MAA just bought this deal in Dallas, 386 units, sort of in East Dallas, sort of northeast of downtown. And it's a brand new deal. So it's built in 2024, 43% occupied. They bought it for 272,000 a door. And their plan is to hit sort of a stabilized number, 5.5%, 6%, once it's all said and done. But right now it's at 44% occupied. So they bought 3 properties in 2024. On average, they were about 65% occupied. And it seems like they're selling some of their older stuff and then moving the newer stuff. And they think, even though some of these deals have negative leverage, they think it's temporary. And basically, that in order to make these deals work, if you go in with negative leverage, you've got to underwrite aggressive rent growth in 26, 27, 28 to really make that up. And they're seeing distress on the older side, which we talked about, but they're typically not going to buy any of that stuff. Camden, so they just bought a 352 unit in Austin. Similar story in lease up, 85% occupied. They bought it at close to 5% yield or 5% cap rate. They're focused on the same thing, right? Selling some of the older stuff, moving the newer stuff. As these guys own anywhere from 50 to 100,000 units, I think they've got to recycle that capital over time. And the same thing, they're underwriting outsized rental increases 26, 27. And so here's the cap rate. So this is by far the messiest chart. You're used to seeing just this similar gap. Let's call it anywhere from 1 to 2% between your interest rate and your cap rate. And just the last 2 years have just been jumbled where they've been on top of each other. And so you're just seeing that neutral leverage to negative leverage. And there's a little bit, it all depends on sort of when you lock the rate, because a lot of the 10-year treasury has been moving up and down and spreads have been moving up and down. But, sort of when 10-year was below 4, there was definitely some positive leverage there. And then, Walker & Dunlop is a big Fannie Freddie lender. Q4 was their most active transaction market in the last 2 years. And they're seeing a lot of money, whether from investors or lenders, wanting to get in there and put their money to work. They did have to buy back a couple of their loans. And so the reason I put this in there is that, this is what happens is if a deal sort of goes bad, the lender who does the loan, on the Fannie Mae side, they have to take sort of that first loss position. And so, some of these loans, they were because of fraud, where, people were just making up stuff, whether it was the settlement statement, whether it was the PSA. And, in back showing that chart of 21 and 22, the amount of volume that was happening, these guys just missed it. And so they had to go back and buy back these loans. But this is the story down at the bottom is the people who are on floating rate debt. They all want to move the fixed rate, but almost all of them require cash in refinancing. And so if you can do that, whether GPs put the money in or it's your own deal, you put in the money and you move to 5.5, 6% rate, that's great. But on some of these larger deals, people they don't want to go back to the LPs. They don't want to do a capital call. And so what they're doing is sticking with their existing financing and they're kicking the can down the road for another year. And some lenders are okay with that, and other lenders are asking for a little bit more of a pay down the second time. The first time it seems like, so if you had a loan in 21 and then it matured in 24, you got that 1 year extension to 25. But now those deals are coming up again, and lenders are asking for a little bit more. So not only the extension fee, but maybe a pay down on principal. And if you're able to do that, then you're able to survive another year. The challenge is if you can't do that, or the LPs don't want to put the money in, then you've got to put the property up for sale. And so that's what we're seeing is some of these deals, like in the listing page, that are pretty much at the loan amount right now because of where cap rates have gone because of the interest rate environment. So, like going back to this chart, I would say it's a bit skewed on the cap rate side because if 75% of the deals are Class A deals that are trading, and Class A deals are trading at 5%, and your B and C deals aren't trading because the cap rates should be higher, or the buyers want a higher cap rate, so they're putting in bids at a 6% cap rate or a 7% cap rate. You're just not seeing those trades happen as often, and so it's a little bit skewed right here to the A side right now. But overall, it was a year over year increase from 23 to 24 on the financing side for multifamily. This goes back to maybe a 2016, 2017 level on the multifamily financing side and originations. But this is what everybody's looking at in terms of maturities. And if you look at the amount of maturities sort of in the dark blue and aqua, 60% of the loans were originated in the last like 3 or 4 years, right? So originated in 21 and 22. That 60% is coming due, and that's the stuff that's sort of upside down right now versus some of these deals done in 2016 to 2019. Like, yeah, they have to refinance into a higher interest rate than they currently have, but they probably have sufficient equity um, to handle that, and they don't necessarily have to bring more. They don't have to do a cash and refi on those deals. So here's really a summary of where deals are at right now. You're seeing bank loans sort of at prime, so 7.5, 8%. Freddie Mac SBL sort of in the mid to high sixes. Freddie and Fannie with a buy down, you can get sort of low sixes right now, low to mid sixes, and then non-recourse bridge. This is probably the part of the market that's changed the most, I would say, turning over into 2025 is that a lot more people are in this space, and thus with more lenders, more competition, lower spreads, and more aggressive underwriting on the non-recourse bridge side right now. On the bank loan, this is definitely for smaller deals. You're doing 7.5 to 8%. So if you don't have, and you're bringing some deposits typically on these deals. Freddie Mac SBL, they're moving pretty quickly with the 10-year treasury. We're seeing, majority of the deals 5, 7, 10-year, you're in that 6.5 to 7% range. And then you can do a buy down on Freddie Mac SBL as well. Freddie Mac conventional. So overall, Freddie, their cap for 2024 was 70 billion. They did 66, which was pretty good. And they increased the cap to 73 billion for 2025. And so they'll try to hit that cap this year as well. Freddie, we're seeing them being a little bit more flexible. So that gap that we talked about. So if, let's say you go back to your LPs and you ask for, I need $3 million or $4 million because my loan is only on a 125 debt service. I can only get 17 million, but my loan is 20. What am I going to do? So if the LPs don't put in the money, you can also do, there's a lot of firms out there doing pref equity behind your first mortgage agency loan. And, it might cost you, 7 to 9% on a annual basis current, and then they're going to accrue another 7 to 9%. So you've got to pay them close to 15 to 18% total to be in that position behind you on the agency side. And Freddie Mac um, can work with those pref equity providers as well. And on the Fannie Mae side, so they were a little short. So they came up 55 billion versus the $70 billion cap for 2024. They did have to increase the provision for delinquencies. So 257 million to seven. So increased, from 500 to 750. Some of it was due to fraud. So when you see, agency lenders have to either take back properties or increase their delinquency provisions, it's really and some of it is just the market, right? So bad operations, things like that. But when they have things like fraud or suspected fraud, then it's almost like they set a new level of underwriting. And so that's what we're seeing really on some of these deals is the amount of underwriting, the amount of scrutiny on whether it's your rent roll, whether it's your financials, making sure that's all buttoned up when you submit your package. And then, their economists, just because inflation has sort of been stuck at, 3% for a while now, they're not expecting a meaningful decline on the 10-year treasury this year. And then non-recourse bridge. So when we were at NMHC in Las Vegas, we talked to a lot of bridge lenders, and there's a lot of money out there. And so we're seeing these spreads. So the spreads is, SOFR plus 275 to 375. And so this spread piece, the 275 to 375, that is where people are squeezing more and more. And so if there's more lenders bidding on a deal, they will go lower on the spread, and they might go higher on the leverage over time. And so, if there's only one or two guys bidding on a deal, then they're going to stick to 375 over and take it or leave it. But if there's 10 guys bidding on a deal, this gets bid down lower and lower. Here's some of the deals that we closed last year. Did about 350 billion, and it was spread across, whether it's Fannie, Freddie, HUD, new bank construction loans, Freddie SBL, deals of all size that we worked on last year. In terms of people working with us here at Old Capital, whether the environment is, non-recourse bridge, Fannie, Freddie, we have access to all those lenders. And then on top of that, helping you through the buy process, the asset management process, and even sale process. We're really your second set of eyes throughout it. And then some of our upcoming events here in Dallas, we're going to host a lunch and learn February 26th. So come out to that next week. And then also we do a field trip. We're going to do it on March 28th. Just going to go see some of the properties that we have financed and sort of get to know the story behind those. So if you're going to come to Dallas, it's a little bit warmer in March. So we put it March 28th. Come out and see us and learn a little bit more there at that trip. We talked about the conference. Definitely, that's the big event for the year, October 8th and 9th. So go to oldcapitalconference.com to sign up for that one. And then definitely, if you made this far, definitely subscribe to the channel, like, comment anything that you're seeing out there. And then, if you need help with an upcoming loan maturity, that is like, 50, 60% of what we're doing right now is helping people through those. And then if you're looking at new deals, loan term sheet, send me, your T12 rent roll OM, whisper price on those. And then, if you're just getting started, send me an email. We can go through your personal financial statement and discuss sort of how to structure, the next 2 or 3 months so that you can be prepared for this upcoming cycle. But that is it. Thank you guys for joining.